U.S. natural gas futures attempted to edge higher on Thursday, with the June contract testing the $3.72 pivot level as traders awaited the latest storage report from the Energy Information Administration. However, prices pulled back after the EIA reported a larger-than-expected injection of 104 billion cubic feet, which was bearish compared to market expectations of around 100 billion cubic feet and even more bearish relative to the 5-year average build of 78 billion cubic feet. Weather forecasts for May 7 to 13 indicate mild conditions across much of the U.S., which are expected to keep short-term natural gas demand subdued. A series of weather systems producing showers and storms is maintaining daytime highs in the 60s to 80s across most regions, while hotter temperatures in the 90s to low 100s remain confined to the Southwest and California. With national demand projected to remain light to very light over the coming week, analysts anticipate continued injections into storage. Meanwhile, concerns raised by the Baker Institute about the profitability of U.S. LNG exports, highlighted in my May 4 analysis, appear to be starting to materialize as Venture Global reported lower-than-expected fee revenues from its Calcasieu Pass and Plaquemines terminals, despite meeting shipment targets for the first quarter of 2025. The shortfall overshadowed the start of commercial operations at Calcasieu Pass, triggering a 17% drop in the company's stock and wiping out $4 billion in value. The quarterly report highlighted two key issues: difficulty forecasting due to volatile global markets and increased exposure to LNG price swings as output grows. In my view, this is a significant development, as the current elevated price level above $3 is largely driven by bullish expectations for strong LNG exports. If this trend continues, we could see a decline in U.S. LNG exports and a potential drop in the average natural gas price below the $3 mark sometime in the third quarter of 2025. Prices could fall even sooner if forecasts for a hot summer fail to materialize, further weakening demand. Meanwhile, Putin and Xi signed a historic agreement today to strengthen the strategic partnership between Russia and China. The agreement includes plans to more than double Russian gas exports to China and reroute gas flows from Europe to China. While an immediate drop in U.S. prices is unlikely, this development is expected to exert significant bearish pressure on natural gas prices over the longer term. Given expectations for another large storage injection and limited weather-driven demand in the near term, the outlook remains bearish unless bulls can manage a close above $3.75. On the flip side, a failure to break above $3.75 could lead to a pullback toward the $3.30 support zone. If that level gives way, the next key support for bulls lies near $3.16. Please like, subscribe, and comment to support the channel. See you in the next one.